Yes, welcome from us as well, and thank you for the great presentation, which was very comprehensive. I think we're gonna touch on a few points which you mentioned as well, or expand on them a little bit, or give our own perspective. I think that's part of the risks of not knowing who's gonna present what. But I think we can definitely expand on some points a little bit. My name is Leo PRIMAVESI, and I'm here with Alina GISPERT and Daniela Morales. And yes, we're going to talk a little bit about your paper. And we're going to start with a little quote from your paper, which is the starting point for our shared extensions. And that is that the impact of tax incentives on tax revenue or investment will depend not only on the reduction in tax costs measured through the ETR, as you mentioned, but also on behavioral responses to these cost reductions, such as take-up rates or the success in creating additional investment. And then you say that evaluating these additional elements jointly with the ETRs is key in assessing the effect of policies. And we think that as well. And I think it's very essential to note, if you focus a lot on ETRs, that the point here also is how companies are going to react to those ETRs and whether, profitability of the investment is the only factor affecting investment. You already pointed towards that you think that it's not, that there's many other factors. We're going to go a little bit more in detail in that. So our extension here is what does economic theory and empirical research say on the effect of tax incentive on investment, and we're going to go along multiple lines regarding this. First of all, I'm going to talk a little bit about economic theory, talking about that. So economic theory effects in different schools of thought of tax incentives and corporate taxation reduction on investment. Then we're going to look at a little bit of empirical evidence, and then we're going to take a little bit more of a global perspective and also talk a little bit about the two pillars and the global minimum tax rate. What does economic theory say about tax reduction in economic theory what does economic theory say about the effect of tax incentives on investment? First, we're going to quickly talk a little bit about mainstream economics, since it's very prevalent. Here the main concern historically is that the tax structure distorts perfect markets and directs investments in less efficient sectors than they could be, in doing so harming growth. Main papers for this are Judd and Chumley in the 80s, which effectively in their models always calculate a perfect tax rate of 0. And this also kind of goes into later generations of mainstream, but this has also been questioned in the mainstream, obviously out of a pragmatic perspective. So, for example, Agian 2013 says if taxation is necessary, for example, if you assume that you need a certain amount of government expenditure, so you need a certain amount of taxation, then capital taxation has a less distortive effect than labor taxation. Yes, saying that you should rather reduce capital taxes than labor taxes if you have the choice. Let's look a little bit more into heterodoxy, especially post-Keynesian economics. Here I've brought you two investment functions. First of all, a Neo-Kaleckian investment function. And here it's central to see that, this works as well, nice. So you have multiple factors affecting investment here, and this is aggregate investment. First of all, we can look at the omega here, which is profitability. Of course, here effective tax rates come into play. So here you have a negative effect of effective tax rates, you have a positive effect of tax rate incentives on investment overall. But then also you have many other factors, for example, animal spirits, the A here, which has a positive effect on investment. So you have like multiple things affecting the optimism, you could maybe say, or the intuition of investors. For example, something such as institutional stability or certainty about the future. And then also another important part is the U minus UN here. This is capital utilization minus the normal capital utilization rate. And this is a channel of aggregate demand. So what we're saying here is that if firms are below a capacity utilization that they aim at, then they are probably not going to invest a lot, no matter how profitable it is, because they don't want to expand their capacity and in the end not be able to sell the stuff which they are producing with the extra investment. And this channel is very central because aggregate demand is very central in post-Keynesian economics, even to the extent that in this Ruffian supermultiplier investment function, the other 2 points go away. So here we only see that demand is basically determining aggregate investment. And here it's important to note that in this demand channel, there's a negative effect of tax incentives on investment because tax incentives lead to a negative distribution effect. So because tax incentives on business taxes will increase business income and or capital income and will reduce labor income, you have the effect that more rich people have more money, which save more, which has a negative effect on aggregate demand and therefore negative effects on capacity utilization and therefore investment as well. So we see there's first of all a negative side effect in the form of income inequality, but also it could be, and we've shown this, like Jonas and me, in a paper last semester in the Saffian supermultiplier model for Germany, shown this first of all for corporate income tax reduction, but also for a tax allowance, which the German government has planned, that there's negative effects on investment in theory. But what does empirics say about it? I'm gonna give over to Dani for that.
Thank you, Leo. Okay, I think you touched upon this in your presentation as well, so I will go a bit more into detail about this. And if do tax incentives really attract more investment? You talked about these mixed results depending. But something that I decided to use only reports here, so World Bank or OECD or IISD. And one thing that they mention is that little or no direct effect of the tax incentives on aggregate FDI, especially, and this is important, in the either global south countries, emerging economies, or developing economies, depending on who's talking. That's the definition changes a bit. So in these cases, investment decisions tend to be much more dependent on other factors such as political and macroeconomic stability, quality of infrastructure, and regulatory certainty. When these factors already exist, then tax incentives are more effective. So, for example, if you're going to make an investment and you have to choose amongst 2 countries that already have these similar situations, you have similar situations, then your tax incentives can be a factor that determines whether you invest or not. And this is some studies at firm level confirm that this is something. This is the level at which this would happen. So in these reports, you can find that long-term factors tend to have a bigger impact than shocks that are related to tax incentives, that especially if they don't come as part of a broader strategy. So this also comes at a cost, and particularly because the paper that we read was referring to sub-Saharan countries. For these countries, it means a fiscal and an opportunity cost. It is an additional fiscal cost by eroding the fiscal revenue. You mentioned that it doesn't, countries tend to like using this because it doesn't come as a reduction when you get to present the numbers at the end of the year. So it's a bit easier to implement in this sense. However, for the same reason and for the erosion of the fiscal revenue, it crowds out public spending in other areas. In this case, I decided to talk about social expenditure. You mentioned the Global Tax Expenditure Database, and in this case, when you analyze the numbers that they have for sub-Saharan countries, it says that these countries have foregone 1.8 to 2.1 GDP tax incentives in the last 2 years, so 2024 and 2023. And it's important to understand that these countries already have a small tax to GDP ratio. So for these countries, it implies an even bigger cost. And just for comparison, so you understand, social protection expenditure in Africa, it's about 2% of the GDP. So these countries are giving in tax incentives around the same that they use yearly for social protection. So as part of replying to the question that initially Leo presented, and as part of like a little takeaway from this initial part, I would say that if you go and analyze from the theory, it depends a little bit who you ask, what the effect of tax incentives are, but in some ones, there is no positive effects of the investment, of the tax incentives in investment. And also, as Leo was mentioning, there are negative side effects regarding to increasing income inequality. There is also empirically lesser impact of tax incentives when compared to other variables, and the lower government spending might, I really forget to breathe. Lower government spending might destroy the positive effects on output and hold investment back, since public infrastructure is missing, which is something I mentioned before. Now, we want to be a little bit more optimistic and say, how can these tax incentives be actually effective? So we brought Board 2025, in which she mentions how a strategic industrial policy can be a factor to foster growth. And she mentions the strategy of carrots and sticks, and how tax incentives can be a way to direct investments toward sectors that you prefer, and use sticks or other strategies to punish or to divert investment from sectors that you want to can consider undesirable. This strategy is important that it only works if there are sufficient punishments that act for undesirable sectors, while you have carrots to attract the desirable investment. In the clean tech sector, for example, China is a positive example, according to Gabor, because of the high growth through industrial intervention. However, she mentions that Europe lags behind because the strategy is mainly carrots only.
Okay. First, thank you very much for your presentation. Was especially really pedagogic, and for people that doesn't have so much macroeconomics, it was like super useful. And I'm going to start talking about Argentina. I don't know why I didn't born there. But in 2016, our president Mauricio Macri was with a campaign that we are going to receive a lluvia de inversiones, that is literally a rain on investment. So basically he did a whole campaign saying, okay, we have this strategy that is the thing that we were talking about, massive deregulation, removal of capital controls, and tax reduction. So supposedly the logic was lower the barriers, taxes, and foreign capital flow in. But we are still waiting because, of course, this never happened. Not only the rain never watered to the real economy, also we didn't have any effect on productive FDI. And the capital that entered disappear, we can say in a way, but actually was primarily as a short-term speculative finance, what we call bicicleta financiera, the carry trade. And as soon as macro volatility returned, because that also always happened in my beautiful country, the capital fled away. So this case is like a small proof of the thing that Daniela and Leo were saying, that a business-friendly tax regime cannot compensate for the lack of aggregate demand and the fear of default of the valuation in the countries. So we want to talk a bit more about the context, how these tax incentives are implemented. I think you mentioned almost all the things that I'm going to say, but in a different way. But we can see that in a more global north perspective, these incentives are instruments for fine-tuning behavior, example, green transition, R&D, all things that you already mentioned. And also they are like really tightly constrained for all these, for example, in Europe, the European Union and the regulatory framework that doesn't allow for the countries to compete inside with between themselves inside Europe. And then in the Global South, a lot of times you see that we are in a context of an asymmetric risk, so environment, so they are doing these tax holidays also as a survival mode, even when the outcome is a lot of times negative, as you already show. So it's at the end, this apparent, when they talk about generosity of these African countries, especially in the special SEZS, Neo Zero ATRS, sorry, reflects a risk premium paid to investors. And then we also bring the Pillar 2, the thing that you explained really well. And for this, we are going to have like two visions, one of the IISD and one from the KPMG, because we want all the voices to be part of this conversation. They say that it could have a policy bias, this Pillar 2, because how treats different the tax holidays, putting like a punishment on that to force the country to do a top-up tax. So the incentive that was used before to be more competitive is like effectively neutralized. Disclaimer, this doesn't mean that we are not agree with the global minimum tax, because when we were writing the slides at the end, it sounds like, okay, we are criticizing, so we are not, no, we want to tax the rich, definitely. But also it's like this double phase of the Pillar 2, that when you are talking about qualified refundable tax credits that are more common in Europe and R&D and income, so it doesn't have at the end the tax reduction. Yes, so this maybe can continue inequality deep, to say it in a way. And then advisors are warning multinationals that the era of simple tax exception is over. We also don't really think that, because they always find a way, but we believe that we are going to be able to do better regulations. So the developing nations face this dilemma. Okay, if they maintain a 0% rate, the MNS, home country, collects the other 15% tax, so they are in this situation. And they lose their primary attraction tool. Yes, but this is something that we already discussed, so we are going directly to the questions. So, how should developing nations redesign their safety frameworks to adapt this new reality? Do you see a viable path for them to transition toward the Pillar 2 compliant instruments, like credits, given their administrative constraints, or does the OECD envision other mechanisms to safeguard their competitiveness? And maybe to this question, I would add that you said that now they want to take the conversation to a level of UN, which I think is super cool. So maybe instead of only answer from the OECD, you could like give a broader answer to that. Thank you.
Yes, my question is the first one. It's a little bit of an overarching one. I was asking, what do you think are the conditions for a tax incentive to actually increase investment, and how do those conditions differ structurally between Global North and Global South?
My question is the second one. But I would like to ask you about something that you mentioned in the paper you didn't mention here, but is that in some papers in some countries you find patchwork of tax incentives. So I would like to ask you, what policy recommendations would you give to countries that could have a greater impact, and maybe that would make it more transparent to analyze ETRs? That's it. Thank you very much.